Morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Been talking investing this morning. One of the things I'm going to offer up to you, retirement income analysis for the first 10 callers to my office this morning, 615-376-5325. You can get a free retirement income analysis. So a lot of things I'm going to talk about this morning. We talked about earlier with our caller Joe about how to reduce your taxes, how to take money out of an IRA with minimal tax, how to do Roth conversions where you can maybe take some of that taxable money and convert it over into tax-free money while minimizing the taxes at the same time. Keep in mind, right, it's not just what you make, it's what you keep. And this is the thing, if you're not taking strategies that are available to you to reduce taxes, you're just giving money away to the IRS. Now, if you want the IRS as a beneficiary in your estate, you know, power to you, but that's not what most of the people I talk to want to do. So if you want to reduce taxes, this is one of the ways we're going to get into showing you how to do that, how to invest in such a way as to minimize your risk, okay, relative to the reward that you're seeking. Again, first off, determining what's the needed rate of return on your investments to maintain your standard of living, quality of life, to never run out of money. Right? It's not about getting rich, it's about never being poor, never being broke. Okay, always having enough income to maintain your standard of living and quality of life, because there's things that are going to come up. We're going to get into health care with you and what those expenses, explain how Social Security works, what the best times to take Social Security, and how to navigate the confusion around Medicare, you know, Part A, Part B, Part C, Part D. What does all this mean, and what is it going to mean to you in terms of expenses in retirement? Medicare supplements or Medicare Advantage plan, what's the best way to go? That's part of the analysis as well. It's about keeping more money in your pocket, all right, less going out with regard to risk, with regard to taxes and other expenses. With this, when you call the office, Debbie's standing by. She'll get your information, send you out a checklist of things, of documents and stuff to bring to the appointment to get the most out of it. No charge for this, okay? Take advantage. We'll also send you out those first 10 callers a free copy of my book, 7 Steps to Financial Freedom in Retirement. And I cover a lot of the things that I do with my clients each and every day and have over the last 20 plus years, 25 plus years actually at this point. These are strategies that are proven strategies. We've seen not just the implementation of these, but also over time how they've played out, all right? And I'm going to share some of that with you. So let's go back to the market, because I want to try to squeeze some things in that you can use today as well. So an example, if we look at the markets, investor returns, the chart I'm showing you here is from Dalbar, and this is again showing the average mutual fund. So if you look at the far left, equity mutual funds, and you look at that 12-month number in 2014, all right, now in 2015 the average mutual fund would have been about a 0 to negative return, and the S&P was right around a +1, I think about 1.25. We're still waiting for some audited numbers, but it should be right around in there. You're going to be looking the same. Dalbar will be coming out with our 2015 numbers here soon, and we'll share those with you. In the preliminary research I've done though so far, 2015, not a great year, and obviously 2016 is starting out even worse. Now let's take a look at the next slide. This is the average U.S. equity mutual fund. Now what we're seeing is if you had invested back in, and this is showing long term, starting in 1972, a $100,000 investment, and based on the average mutual fund would have grown to about $3 million. Now of course this is over a 45 plus, you know, give or take a year, 45 years. Now keep in mind though that over this 40 plus years, that growth from 100,000 to 3 million, look at the S&P 500 just above that at 6 million, okay? So you can see we're buying the market, all right, an index such as this is where the S&P outperforms like 90+%, 96% according to Tony Robbins in his book, of equity mutual funds out there. All right, so let's take a look at the next slide. All right, again, this is the way that the reason for even minimizing that further. So first off, understanding a couple of premises here that are facts, I should say. This is what research shows us when we look back in time. We see that the S&P outperforms the average investor. simply said, all right? But it's got a lot of volatility. This is the Markowitz Efficient Frontier, developed by Dr. Harry Markowitz, who won the Nobel Prize for Economics back in 1990 for his equity research. And this is the foundation for a lot of the research that's done today. And it has to do with putting together asset categories that have a negative correlation. Now this came out, and in subsequent years, even up through Dr. Fama's research, one of the things that we get into is the mixture of stocks and bonds together. So a moderate portfolio, for instance, would do as well as the S&P, but with half the risk. All right, that's what's being shown here with this Efficient Frontier. It's reducing your volatility, that up and down, so that you don't take as big a hit. All right, now let's talk about this for a second, because this is one of the areas, we can go ahead and get rid of that slide. This is one of the areas when it comes into most recent research that we're seeing is that negative correlation, which is what we're seeking, and that's how we build portfolios. So it starts with, stocks to bonds. These negative correlation simply means when bonds are up, stocks are down, and vice versa. Okay, so when you have two asset categories, large companies and small companies, domestic and international companies, growth companies and value companies, all of these are asset categories, according to Dr. Fama's research, that have this negative correlation when back tested over time. Now, in recent history, we've seen this negative correlation not be as quite so we haven't seen as much of it, let's say. So meaning that they tend to move more together. And that's a problem when it comes to, in other words, in 08, that bear market, you saw that it was difficult to get any kind of return. Bonds did better than, say, stocks in that scenario. But if you looked at internationals and small caps versus large caps, everything was taking it. It pretty much took a hit. So the market was, for most investors, that was a really rough year. And the bonds smoothed it out just a little bit. So depending on your portfolio, do you know how much you have in bonds in your portfolio versus stocks, as an example? This is what the starting point. Stocks, bonds, and a little bit of cash or a money market account. Now, when we're seeing less of a negative correlation, these things are moving in, then we've got to be even more careful of how we put these together. And we have to look maybe at some of the more recent research, and are there some hedging strategies that may help us reduce that risk further and get some gains. So now let's take a look. Shiller Barclays CAPE U.S. sector. This is the Shiller Index, okay? So if we can get that one up. Professor Robert Shiller at Barclays came together with this. Again, he won the Nobel Prize in economics in developing it, and we'll keep going forward with that one, Marilena. So with the Dr. Shiller, professor of economics and finance at Yale University. He's the best-selling author of Irrational Exuberance and co-developer of the CAPE Index. And this was done, what we've seen with Dr. Shiller's research basically is that the CAPE Index has been a pretty good forecast when we look at how it forecasts what's going to happen in the market over given like 8 to 10 years into the future. Okay, short term not as much so, long term more so. Now what we've seen with it is that basically Dr. Shiller is using some of the principles that we see with value investing. So to put that in perspective, what do I do with it? Here we go. All right, there's a book out. Well, this book's been out for a very long time. In fact, it's a classic. The original 1949 edition, it's The Intelligent Investor by Ben Graham. Benjamin Graham was the mentor, if you will, and teacher of Warren Buffett. All right, he developed the book on value investing, and it's still around today, having gone through a few revisions in that. But the value investing model is something that Dr. Shiller has used. So if we're looking at, let's see if we can get this slide if we have it, identifying value and reducing risk. Value investing basically, again, goes back to the 1930s, and it's where they're seeking to buy assets when the price is low, finding values out there, in other words, and then being able to sell them when the price is high. So this is what the index looks like when the Shiller Index. It takes the 10 market sectors, okay, each month, 10 market sectors of the U.S. economy are evaluating using this CAPE indicator to identify potential value. So we're looking for value. This chart is showing in the blue what the S&P did since 2002, and then it's showing the Shiller Index in the green and how it performed. So it's identifying then the 5 market sectors with the best value, selecting the 4 of those with the best value and strongest momentum, and then that's the way it runs for that month, and then it changes each month doing that same formula. Now you can see over that period the S&P had a return of 7% and the Shiller at about 10%. Okay, so this is something new. Keep in mind what we talked about before. What did we determine? That the average investor, right, the S&P 500 outperforms 96% of investors, and now we're seeing equity fund investors, and now we're seeing a Shiller, an index that outperforms the S&P, at least over this period, and that's where, you know, this is something else. We can go ahead and get rid of that slide and go to the next one here in a moment. That's the Shiller Index. One of the things I want to be clear with, we're going to get into this next one, which is a Mosaic, but we'll hold off on that one for just a minute, Marilena. So here's something to understand with this. When it comes to investing, okay, no one has a crystal ball. No one knows what the market's going to do. So we're looking at what is the statistical probability of success? How can I hedge, okay, my investment strategies in such a way that I protect myself, I have some downside protection. Okay, some of the things we're looking at with regard to other indexes, these indices that were like Shiller and Mosaic, when we talked about the S&P relative to the average mutual fund investor, these are ways we're trying to put together in strategies that will benefit you in terms of giving you that positive rate of return, keep you ahead of inflation and taxes, and yet maybe reduce, ideally, in fact that's the goal, is to reduce volatility. Now I've talked about fixed index annuities as another way to do this, where you can protect your principal, okay, where in the worst case in any given year, even a year like this one, the worst you can do is 0. And here's the plus side. What do we say about value investing? You want to buy low and sell high. Well, one of the things that an index annuity can help you do is that it can help you with, when the market goes down, you hold on to your principal, but you come back into the market at this low point with all that principal, so that your potential for growth going forward is much greater. We're going to get into some of how that works and also some additional investment strategies. And then here's the key. It may not be that there's just one that works. It's about how to blend them together to get the best result. So we're going to do that when we come back. Join us here. We'll be right back on the Retirement Report.